Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by a Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with a Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. All right, we're back for another episode of the Mortgage Broker Podcast, and we have a special guest today, the Chief Economist of Dominion Lending Centers, Dr. Sherry Cooper. Dominion Lending Centers is one of the networks that our brokerage is attached to, and we really value your time and coming on the show. Derek is my co-host today, and we're going to jump into things. There's a lot of crazy stuff going on in the world, to say the least, and we're going to try to unpack as much of it as we can in this episode. So I'll pass it off to Dr. Sherry Cooper. Thank you so much for joining us. We really appreciate this.
Thank you.
My pleasure. It's very nice to be here in these clearly uncertain times.
Very much so.
Yeah, it's certainly a timely for this conversation, and we're excited to get this out to the public and to our brokers for sure. I mean, I think one of the reasons that we wanted to engage on this is obviously for us to learn more, because that's important, because we are certainly not economists. But sound advice is one of the most important things for a broker to have to offer to their clients in uncertain times. And thinking back to pandemic, there was a lot of unknowns and a lot of volatility. And I think it's very important for brokers to capture correct information and communicate with their clients, because if they're not doing that, who is? And hence why we're here. So again, really appreciate your time here, Dr. Sherry Cooper. And maybe if you could, because you have a very extensive background, maybe just touch on a little bit of your history in the workforce, and we'll kind of dig in from there.
Okay. Well, I'm a dual Canadian U.S. citizen, born and raised in Baltimore, educated in the U.S. as well. I have a PhD in economics. Following my degree at the University of Pittsburgh, I went to work at the Federal Reserve Board in Washington. In fact, during the inflation periods of the late 70s and early 80s, I worked very closely with Paul Volcker at the Fed, and then went to Federal National Mortgage Association, better known as Fannie Mae. And then one day got a call from Canada. I'd never been to Toronto, but a job offer awaited me, and I said I'd try it for a year, and that was decades ago. So it certainly did work out well for me. I was chief economist at Burns Fry, then laterally moved to BMO when BMO bought Burns Fry. I was chief economist at the Bank of Montreal for almost 20 years. And I left BMO in 2012. And for the last 10 years, I've been chief economist of Dominion Lending Centers, which takes my career right back to the beginning, in the sense that at the Fed, I followed mortgage markets and mortgages, the savings and loan industry, and housing in general. So I'm back doing that again. And clearly, because housing is the most interest-sensitive sector, it's the one that requires an economist's attention, no matter what time of the cycle it is. I do want to say that though we are in a period of extraordinary uncertainty, just as we were 5 years ago in early COVID days, it turned out that COVID was a whole lot better for the housing market than anybody would have imagined. And that's because interest rates plummeted. And I think we're once again, this could turn out to be not as bad for housing as many would imagine right now. Clearly, consumers and businesses do not like uncertainty. And when you're making big ticket decisions, and there's no bigger ticket than buying a home, you want to feel that you have some visibility into the future. But in my view, this will be so disruptive for the global economy that interest rates will ultimately fall very sharply as well. Not because of anything more than just what Donald Trump is intending to do. And this will be very negative for global economic activity. In other words, even though tariffs lead to a one-shot increase in prices, I think that the longer-term, bigger impact of all of this will be weaker economic activity and therefore downward pressure on interest rates. That the inflationary effect of this will be the first effect, but also very short-lived, because demand in a global perspective is going to be disrupted. And clearly, many businesses will reduce their investments, will reduce their potential plans for expansion, and tighten their belts, and consumers will do the same thing. And once that happens, of course, the central banks quickly pile in because they're already nervous. And we saw yesterday that the federal financial regulator in Canada, OSFI, has announced that they are putting in place programs that will potentially be needed to help the banks in Canada weather this storm. So
interesting.
We're really moving forward quickly.
I mean, it is a very interesting times, and like for me, it's a head scratcher in a lot of cases, like a lot of ways when I don't understand, really any of the why behind why this is happening. And I think for our listeners, I think most listeners would know what a tariff is. It's essentially a tax. I don't really see how to look at it any other way. Like this might be hard to ask or answer, but like, why is this happening? And like, is there any examples of something similar in the past that we can kind of draw from?
Well, that goes back, to answer the why, you really need to go back to what is it about the U.S. populace right now that Donald Trump is so popular and so powerful. And this is an issue more for sociology and political science than for an economist. But clearly, the tensions within the U.S. and the polarization within the U.S. is why we find ourselves in today's circumstance. Trump has always attempted to appeal to the working class. And the U.S. broader middle class has, many of people in the middle class have been slipping in terms of their standard of living in the United States. And it's largely because of just how important education and technological innovation is to economic success. And working class jobs that did not require a college education became fewer and far between, and the compensation levels just didn't keep up with inflation, which made incumbents very unpopular. And we see that with Justin Trudeau in Canada, we see it with Joe Biden in the United States, and pretty much everywhere in the world. So Trump's back in spades, and this time he's prepared. He knows where the roadblocks are. He saw from his first term how difficult it was to get the things done that he wanted to do, largely in terms of building a wall, reducing immigration, the expulsion of illegal immigrants, as well as his notion of trade. What he doesn't seem to understand is that free trade led to great economic prosperity around the world. The opening up of China, for example, way back in the late 70s, when Deng Xiaoping announced that this would be, that China would look at market economics, not just a communist system of economics. And since then, China, of course, became the global powerhouse for exports, particularly of inexpensive consumer goods, flooded the US market through companies like Walmart and Amazon, flooded the global markets with their products. And there was great economic prosperity as a result of that from a consumption perspective. But as production, manufacturing moved offshore from the United States, a very high-wage country where basic manufacturing became too expensive, both because of the high labor costs, but also high energy costs and electricity costs. So the U.S. created this free trade agreement between Mexico, Canada, and itself in order to maximize the efficiency of where goods and services would be produced within North America. And it all worked very well. But Donald Trump believes that the U.S. trade deficit is symptomatic of unfair trading policies, which is not true. The reason the U.S. has the biggest trade deficits in the world is because the U.S. is the richest country with the most voracious consumer spending appetite. So every country in the world wants to tap into the U.S. consumer market. And that's good news for everyone. If trade hurt the United States, the stock market in the U.S. wouldn't be at a record high. And what he's doing now is going to hurt domestic corporate earnings. The CEO of Ford has been very vocal on this, that the possible imposition of tariffs on products like steel and aluminum will dramatically increase the cost of consumer goods, from automobiles to beer cans. And it will make housing construction a whole lot more expensive as well. And all of this is very, very negative for economic activity. And yet, it's Donald Trump has in mind a 1950s mindset that unless you're a manufacturing powerhouse, you're really not economically successful.
Right.
And that's just not true.
So there's obviously a much bigger, as a consumer or a citizen of Canada, we have our own concerns, and there's obviously a much bigger global impact that I think a lot of people probably aren't understanding, or no one has really reached that level of understanding as of yet. So I appreciate the insight there. If we were to talk a little bit about impact on housing, we'll primarily focus on housing because of the business that we're in. Potential short and long-term effects, and we have a couple other topics that we'll run through, like Bank of Canada outlooks and the Canadian dollar. But if you were to kind of summarize what you would expect as an impact on housing if tariffs were to implement, and one other piece I'll kind of throw in there. Currently, we have a threat of tariff. What's worse, a prolonging threat of tariff being bumped month by month, for the course of years, potentially, or just actually having a tariff implemented so that we can start to adapt? I guess if we want, I'll throw that back to you for a comment.
Well, neither is good, and I'm hoping that Trump's bluffing. And in respect to, he is clearly using this as a cudgel to get what he wants from the leadership of governments around the world. But actually implementing, whether it's 25% tariffs or 10% or 50%, it's a different story, because it will be paid. It will no doubt lead to higher consumer prices, and initially in the United States. And we know that one of the big election issues was inflation, and clearly, once people understand that the impact of tariffs will be higher prices, they're not going to go along with it. I mean, they're going to be very, very upset that their purchasing power has diminished so much. But if you didn't have that effect, you couldn't possibly expect to have the knock-on effects of increasing manufacturing in the US, which is exactly what Trump wants. Now, let me just say that we've done this before. Back in 2018, Trump did impose tariffs on steel and aluminum. And here we are all these years later, and even in the immediate aftermath, there was not a pickup in steel or aluminum production within the United States. The US doesn't have the capacity. And the cost of energy to create aluminum, I mean, just the production of aluminum itself takes an enormous amount of power. And that's why most of the aluminum is produced in Quebec, where hydroelectric power is relatively inexpensive, much less expensive than in the US. So it makes all the sense in the world that the United States import aluminum from Quebec. And they actually, I mean, with a weak Canadian dollar, or conversely, a strong US dollar, buying aluminum from Quebec is far more efficient from a monetary perspective than the US having to build its own structure to replace the aluminum. And it's by far the bulk of the aluminum that's imported into the United States does come from Canada. And that's just one example. Similarly, in the auto sector, you know, our two most important exports are oil and gas and automobiles. And the automobiles are all American company automobiles. And these autos, in order to complete a finished product automobile, it moves across North America, many times before the finished product is actually purchased. And if we disrupt it, which is exactly what we're planning on doing, it throws so much sand in the gears that first we're going to have supply shortages, because you can't turn this around on a dime. It's not like you can just flip a switch and suddenly the 10% of American automobiles that are produced in Canada will be produced in the United States. And the companies themselves don't have the resources to build the number of plants that would be required. And the cost of running those plants would be far higher than the cost right now. So what's the point?
Yeah. So it sounds like, and this is kind of a theme, is Canada's, ideally working towards a more self-sufficient model, more domestic production. And like what comes to my mind is that a realistic and viable solution long-term? It sounds like it could be to an extent, but it will just take quite a bit of time to get there. What are your thoughts on?
It's not really possible, though. I mean, orange juice and pineapple, bananas. Canadians aren't going to be satisfied with, let's just look at the food sector, with food that's produced in Canada alone. We all know all the options out there. And the global, all of our well-being has improved with globalization and global trade.
Does Canada then look at other countries from a free trade perspective? Like, if this continues and this isn't just a flex, or whatever maybe his motive is, do we then start looking at countries like Mexico or other countries to do have different trade agreements when it comes to being able to satisfy Canadians?
Well, yes, for sure. Having more customers is a good thing. But remember, the reason the U.S. is such an important market absorbing 75% of all Canadian exports is because it is the richest and spends more money on everything than any other country. And we're nearby. And the trade routes are well established. And so try to imagine Canada replacing the US. Who in the world would be buying 75% of Canadian exports? Well, especially when you're talking about things like oil, you need to transport that oil. And we do transport our heavy oil to the US refineries through our pipelines. And we don't have pipelines to China. And it's very expensive to transport oil using cargo ships. And that infrastructure isn't available. So there's no simple answer to this. And when you look at Canada is a major producer of metals and minerals. And many of these are very heavy and therefore very expensive to transport. And we've got a whole trucking system and railway system already developed between Mexico and the United States and Canada. The U.S. in negotiating these free trade agreements with the other two countries wasn't doing us favors. This was to the benefit of all three countries.
Yeah.
And the U.S. is going to be shooting itself in its foot if prices of American-produced automobiles go up, because there is no such thing as a fully American-produced automobile.
Yeah, that's when, like, again, it's such a head scratcher in so many ways. It's hard to like find any comfort or any, in understanding this. I keep going back to the housing sector and I look at what occurred in the pandemic with rates just dropping so significantly, which, like you mentioned, we should be expecting given all of this. How does that impact the housing market? Because in the pandemic, everyone was trying to buy a house and prices went up. There was subject free offers, was a normal thing. People didn't even have subject to financing. It was very rare to even have a subject to financing period. Given all of this, do we, with rates going down, do we see the housing going back in that sort of a trend, or how do we, where do you see the market from that perspective, comparing it to the pandemic?
Right. Well, every situation is different. One of the things that was very positive for housing, aside from low interest rates during the pandemic, was that we all had everyone was at home, children and mom and dad, and everyone was working from home, whether it was doing classes or doing your job. And people discovered that their homes just weren't adequate any longer for that kind of a change. And so, especially younger families, the move-up market accelerated. People wanted more space. Interest rates were at rock bottom lows, so they went ahead and did it. Also, it was encouraged by working from home, which has been sustained in many sectors, and therefore you didn't need to live as close to the job site, and therefore you could move further away and spend less on housing and get more for your money. Now, it'll be different this time, but no question there's pent-up demand for housing because the housing markets have been relatively inactive in the last several years since they began to hike interest rates in 2022. Canada has been very aggressive in taking interest rates down, and I sure don't think that's over yet. So I believe that the overnight rate, which is currently at 3%, down from 5%, that's a huge proportional decline.
Yeah.
And more to come, because we will see such a slowdown in economic activity, and the central banks will, at least our central bank, will continue to cut interest rates. And that in itself will spur housing activity. but not for those who lose a job as a direct result of all of these machinations. And, it depends on whether or not these tariffs are actually implemented, and I'm not sure they will be, but in the meantime, we've got a lot of political uncertainty too in Canada, both provincially and federally. So it's an extraordinary time.
If the tariffs do begin on March 4th, like how do you expect Bank of Canada to react? Again, comparing to the pandemic where there was emergency rate cuts for those reasons, do we see something similar in this case?
And just to add to that, sorry, before you jump in, just to add to that, because from everything that I understand, the Bank of Canada is kind of priced in, or maybe it's just economically they've priced in about 1 to 2 more cuts, potentially this year. Has the Bank of Canada released any information on how they might react to that? Just to double onto Dean's question.
Well, they released the minutes of their meeting on the January 29th meeting. And the minutes showed that they had quite a fulsome discussion on the potential for tariffs. And they concluded that though there could be or would be upward pressure on prices, the bigger effect would be a slowdown in what is already a relatively slow economy here in Canada. And that, they said, was one reason why they went ahead with the 25 basis point rate cut. So they did see it as their job to smooth the transition. And I have no doubt that they will continue to see it that way. I think Canada needs to be cautious about retaliatory actions because, two wrongs don't make a right. And the last thing you want to do is make the situation worse than it needs to be. So I think that first we shouldn't assume that tariffs are going to be slapped on, because really what Trump would like to do is renegotiate the free trade agreement.
Right.
And it will be renegotiated next year. That was already slated, but why not speed it up? Why not renegotiate now and therefore potentially avoid the tariffs? The thing that makes that problematic, though, is that he truly doesn't realize how his goal of restructuring America of the 1950s, where manufacturing was king, could even be implemented, because the world has changed. So much of it is digital. So much of it is not heavy metal bashing production any longer. And the US is still at the leading edge of, Silicon Valley type inventions. And that's the way to the future. So why would we want to go back to steel production?
Right.
It just doesn't make sense. And Canada is naturally endowed with a much stronger energy grid, be it any kind of energy, hydroelectric or oil and gas. And we already have a labor force that's very skilled, and it's cheaper for the U.S. Auto companies to produce in Canada.
Hey everyone, Dean here. Quick timeout from the episode to share with you the ABW Tuesday Mortgage Memo, your weekly market highlights sent directly to your inbox every Tuesday. This is certainly one you're not going to want to miss, so make sure to sign up now. You can do so with a link in the show notes, or you can head to joinabw.ca and sign up there. This is a high-level summary of market developments, regulatory updates, and housing trends every Tuesday. So hope you enjoy it, and back to the show.
Yeah, thanks for that. All very interesting information, and just jumping into the housing market component to this again. I know we kind of touched on a comparison from the pandemic and now, and some of the differences. And for all the reasons that you mentioned, there's a mass shortage on housing. We'll touch on this a little bit later in the conversation, but it sounds like there could potentially be a mass slowdown on new construction as well, depending on what happens with building costs, which again will push the shortage even further. And I don't know if this is a fair comparison, but it seems like when we think about the pandemic and how quickly rates dropped and what happened in our housing market, that Canadians might be very sensitive to interest rates. And on the flip side of that, when rates went up, things drastically and quickly did slow down. For myself, with a broker mind, I could see if rates continue to trend down, I think there will be a lot of refinance opportunities happening for people to maybe extract savings within their equity, consolidate debt. Just looking to make things cheaper because, as we all know, in general, costs have increased drastically. I saw a note the other day, whether it's correct or not, but Canadian consumer insolvencies had one of the largest spikes in a very long time, since 2009, after the crisis. So that, you couple that with potential job loss, I think there's going to be a big push for people that are looking for options to help their financial situation. So anyways, maybe we go a little bit deeper on, the differences on pandemic compared to now, and, maybe expectations there.
Well, I wanted to comment as well. Another thing that's happening is population growth in Canada has slowed and much faster than I expected. They have really slashed the number of student visas provided to foreigners. So whereas there were like 600,000 student visas outstanding a year ago, that number is down to about 300,000. And as well, we've seen a slowdown in temporary foreign workers, and a cut in the target for permanent immigration. So that will help mitigate the housing shortage. We've already seen the rental rates have declined sharply. And that's the first round of effects, because most of these temporary residents are renting. So that we've also seen anecdotally a huge pickup in new listings in the month of January and through February thus far. As sellers, there's pent-up selling, pent-up supply, people that have not, who've been wanting to downsize or to sell their properties that haven't put them on the market yet, waiting for a better time. So I think it could well be a buyer's market in the next 6 months. And that is different than what we saw during the pandemic, where the supplies were very limited.
Interesting. Thank you. So quickly want to touch on construction. So there's obviously risk of construction costs going up. I have an understanding that a lot of machinery and equipment comes from the US into Canada. And again, we already have a shortage. And I think, correct me if I'm wrong here, but there's been a lot of delays in construction because of permit turnarounds. So we've been battling our own battles for quite some time that's caused delayed development. And I can only imagine, like I personally know developers, and that their margins are getting thinner and thinner. And this could put it to a point where some maybe smaller developers are just going to throw in the towel and say it's not worth it and look at a different line of business. And, the big ones will continue to monopolize. But are those real fears or real considerations that could create even less construction in the future?
Absolutely. Absolutely. We saw the supply chain disruptions very vividly from COVID. And these now are also, what's going on in Washington is generating a whole new set of supply side disruptions. And it will be compounded by the fact that it is, like the pandemic, it's global, it affects everyone, and there will be sectors within each country where you do see massive layoffs. And the United States, by the way, the other thing Trump is really doing is firing federal workers and streamlining the federal government, if you want to call it that. And that too will lead to slower economic activity and rise in unemployment. unemployment. U.S. unemployment rates are only 4%, and also the U.S. is the strongest economy in the world right now. But Canada, we've been kind of on the brink of potential recession for much of the last 2 years. And something like this could really knock us into a recession. And there will be sectors where the unemployment rate will be quite high. Now, many of these people are not homeowners to begin with, but to the extent that we're all impacted by a slowdown, it's certainly not good news.
Yeah. So it seems like there's a couple factors: lower rates, continued shortage of housing that could drive values and pressure up. And then there's other considerations such as job loss and just weak economic growth that could obviously, it's not going to drive it as much as maybe it did pre-pandemic. So, okay, that's really interesting. I want to touch a little bit on the lending side, to the extent that you can comment. So if I think back to the pandemic, I remember, rates were rushing down, bonds were rushing down, but we weren't necessarily seeing that direct impact on interest rates based on bonds. And if I remember correctly, lenders were actually, they had risk-based premiums that they were adding in. They were kind of preparing for potential risks with job loss and whatnot. Is that something that you would expect? Like, how do you expect lenders to react to what we're dealing with today?
Well, remember there was a mortgage payment holiday.
Yes.
And most people did refrain from making payments until they had to, even if they didn't end up losing their job, and they might well have been able to have carried their loans.
Yeah.
This is not nearly at that stage yet, but OSFI is prepared for it if necessary. I don't think it would be across the board a payment holiday, principal and interest payment holiday, but maybe it would be for certain sectors of the economy where there are massive layoffs. One thing that is true is our banking system is very solid, and we will not allow Canadian banks to fail. So, and if we have a global recession, the knock-on effects of all this disruption and uncertainty will be huge. I'm hoping that doesn't happen, but housing is obviously local. And when we look at Canada, the sectors most vulnerable to the tariffs are the metals, minerals, manufacturing, but also food production, potash, and all of those are inputs in production processes or agricultural processes in North America. And it's going to be costly for the farmers not to have inexpensive potash. It's going to be costly for everyone in terms of gasoline prices going up. We're going to see anything that has metal in it. And that's everything from automobiles to housing to you name it, also increasing in price because of these tariffs. And there will be insufficient supplies. Remember when the world began to open up again in the latter part of COVID, you couldn't buy a new car if you wanted to because it just wasn't in inventory. There was a shortage of the computer chips. So now we'll have a shortage of everything. It's not a smart move, and yet there's no stopping it at this stage.
With affordability challenges clearly, driving more borrowers towards the alternative side. We've definitely seen that within our brokerage in the last 12 months. Huge increase in alternative products, private lending. Do you see that growing, or do you see potentially some flexibility when it comes to our prime lenders to, allow borrowers to qualify at, and remain with a prime lender?
Well, I do think that the prime lenders are going to be more cautious, but creditworthy borrowers will certainly be able to get money. and particularly at lower costs if the economy slows as much as I expect. The other issue is how do these banks deal with, or lenders deal with, delinquencies? Delinquency rates in Canada are extremely low, even though they're up from where they were 2 years ago. But still, compared to other countries, they're extremely low. Canada is one of the most interest sensitive of all countries because our mortgages are so short term, or at least need to be refinanced every whatever it is, at most about 5 years. We become very interest sensitive, but the good news is it means that monetary policy is more effective here than elsewhere.
Right.
So I have no doubt that if the economy slides into recession, which it might, should the tariffs and other export taxes be imposed, the Bank of Canada will be very aggressive. Now, will they take the overnight rate down to 25 basis points again? No, that was a mistake. They saw that. We aren't going to get there, but could we get the overnight rate down to 2%? Yeah, we could.
Yeah, great feedback. And, I guess one other thing that comes to mind for me, everywhere you look, everyone's talking about the amount of renewals. It's catastrophic that are happening this year and next year. So from a timing perspective, if someone's employment or income stream has been impacted by this, in addition to potentially renewing from a 1.5% fixed into a 4.5% term, there's some significant impact there. I mean, I guess this is just more of a thought for anyone listening and speaking with clients. If anyone's in a potential industry that could have a major impact, it would be better to act on these potential renewals, early refinance, whatever it might be, to kind of protect yourself now, rather than dealing that when it comes up. Because if there is job loss or what have you, don't get me wrong, you can renew with your bank if you haven't missed payments. But if you're trying to borrow extra money or get a safety net like a line of credit, it's going to be very challenging if you've had an income impact, right? Leading into my next, I guess, and one of the final points that we'll touch on is just the fear, the lingering fear, the unknown for consumers. We're really very grateful, especially to be able to speak with you, but we're in an industry that there's a lot of communication, there's a lot of stats, there's a lot of communication on what's going on. And so it helps us wrap our heads around it. And I can only imagine that a lot of people might not have access to that or might not go deep on it. So I think for a lot of people, they're getting advice from, a friend at work, a colleague, an aunt, an uncle, what have you. And it certainly would create fear for a lot of people. And I'm sure if you ask 10 Canadians how they feel, they'd say unknown. I guess going into this, do you have any advice for mortgage brokers and or consumers as to how to best deal with this? And I think the biggest question, if someone's on the verge of buying, is it the right move? It's a loaded question. I have my own thoughts on how to answer that, but do we wait for rates to come down? Do we wait to see what happens? And this is the constant battle, I think, in our market in Canada. Look at the last 5 years, there's been ups and downs and busy and slow, and when is the right time? And so I'll just curious to see if you have any advice.
Well, for me, unless you're buying to rent, like you're investing in real estate, it's a lifestyle decision. When you choose to move and where you choose to live and what kind of property you're looking for. And families are growing and needs change over time. And that will be the case regardless of what happens in geopolitical developments. Clearly, though, I think everyone realizes that we're in a period of uncertainty and that it makes sense not to overextend.
Yeah.
But if you can qualify and you have job security of some sort and two incomes in your family is another way of looking at potential job security, then by all means you want to proceed. Life goes on, and there's some real opportunities now in the housing market for purchasers because there's so much more supply, not necessarily new build, but existing homes that are now on the market for sale. And the sellers are going to be nervous about their pricing power as well. And no doubt deals will be made, and they could be quite favorable to the buyer.
I love that you brought up that word opportunity, because there's opportunity in everything. You just need to know where to look. And, if we look at our market the last, couple of years with inflated rates, we've seen a drastic change negatively. Like, we don't see people buying rental properties unless they bought a pre-sale a few years ago and they're committed to it. Like, that's just hasn't been a thing. It hasn't been consistent. We haven't seen investors buying properties for potential lift on value. And I think that's a big driver in why we've seen volumes decrease, transactions have decreased, and I didn't really see a future where those markets would come back, but this could potentially be it, if the timing is right and if you understand what you're looking for. I'm really glad you brought that up, actually. And I guess one kind of closing thought for myself, I'll let Dean take over. The rental market is an interesting piece to me because, like I just said, people haven't been buying rental properties, right? I know immigration's down, which I'm sure would help the rental market, I would assume. But what is your thought on, and especially if we see the construction being delayed or a decline in new construction, what are your thoughts on the rental market, for a renter?
For renters, prices are going down. Rental rates are falling now. And that's particularly to take advantage of that if you move. Typically, if you stay in your property, maybe you won't get a rent hike, but you're very unlikely to see your rent come down.
Right.
But for new renters, it's really very dramatic, and likely that downward pressure on rents is continuing, which isn't good for the investor. But then again, if the cost of carrying a loan to purchase a rental property comes down, which it already has, then you could still have positive carry even with lower rents. The other thing is people do live in these condos, and the prices of condos have come down, and so there's a real buying opportunity for those that want to purchase for their own use as opposed to just for investment.
Right.
That's a great point, actually. Like, just thinking of how many renters are in that ideal product to essentially just buy, opposed to being in a rental situation. That's definitely a key takeaway. Right,
and again, it all depends on whether or not you're likely to lose your job, and sure. Because immigration numbers all come down, I think that unemployment will rise in Canada, but I don't think it's going to be a deep, long recession, because I think the U.S. will go hand in hand with economic slowdown if they really do impose these kinds of draconian tariffs.
That's a great point to maybe wrap up with, and ultimately where we started and why we're having this discussion is just around the tariff and these future tariff policies. Looking ahead, is there any potential future tariff policy that Canadian or home buyers could, maybe pay attention to or keep an eye on that would directly impact Canadian housing market more than maybe others? Is there any one or two that stick out, or is it just all of them?
Well, it's all important, but the sectors that they're targeting, which is energy, metals and minerals, these are the sectors, and autos, of course. These are the sectors that will have the biggest effect on the economy, and mostly in Ontario and Quebec. To a lesser extent out west as well. Potash, of course, is Saskatchewan. And all of Trump's talk about annexing Canada, that's unheard of, right? Like, no president historically has ever said the things that Trump says about Canada becoming the 51st state. Trump wants Canada because of our wealth of natural resources. And that's water, oil, gas, hydroelectricity, all the metals, all the minerals. We are for sure a powerhouse in that regard. And there's no way the US can replicate that. They've got what they've got. That's about it. And though it's always been a bit hard to compete as hewers of just being the natural resource capital of the world, at this stage and at this point in the global economy, I think that we're in good shape. But we are ground zero because nobody exports more to the United States except China. And if you exclude our exports of oil, we actually have a trade surplus with the US. We are the US's largest export market. The last thing the US should want to do is throw our economy into recession because we won't be buying their products.
Great point. Yeah, I mean, it's a very insightful conversation. I certainly have a lot of takeaways here. I learned a lot. I still don't feel any more comfort around why this is happening. And I'm sure we probably won't. And I guess all we can hope for now is just that common sense prevails and the right decisions are made by both governments, like you mentioned. Two wrongs don't make a right. So I guess at this point, all we can do is hope for the best. And the key takeaways that we can control are, what's going on in our business and how to support our clients and give them the right information. And I think that's my biggest, kind of piece to our listeners is, for anyone that, wants to continue to, receive your excellent insights is, being part of the DLC group, getting, constant access to that. When it comes to your blogs and your summaries, it's something that I very much value. So I just want to thank you for that and the effort you put into that. It makes a big difference in our business. So appreciate you coming on and thank you for all that you do.
You're welcome.
Thank you very much, Sherry.
I think the most important service we can provide our clients is information and comfort in terms of it's not a disaster. It makes no sense. Canada's in a very strong fundamental position here, and this will be resolved. I don't know exactly. I mean, as an American, I've been obviously focusing on this as well. He's breaking the law in many different ways, Trump, and the courts are slow, but we'll see if they can at least mitigate some of the damage. And the thing, though, elections have consequences, and he sees himself as having the mandate to push through a lot of unpopular things. So,
on a daily basis.
You bet.
So yeah, thank you again, Sherry. It's been very insightful. We appreciate it extensively. And to reiterate the points that was brought up now and again by Dean is, if you're a broker and you're not educating your clients, someone else is. So that's a gap that you need to fill in your business. And we strongly suggest that you get ahead of it. If you don't understand it, wrap your head around it as best you possibly can. Use resources, such as Dr. Sherry Cooper. And again, so thank you very much. This has been great.
My pleasure.
Thank you, and we're on to the next one. So have a great day, everyone. Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening and see you on the next one.